Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's been an interesting week. Actually, it's kind of slow. And normally this time of year, it is pretty slow for the stock market anyway. Our phone seems to ring quite a bit, taking care of a lot of things. People are getting ready for next year's RMDs. They got questions regarding payments over colleges when they have kids or grandkids that they're helping fund to get through school, and it's a lot of fun stuff. It's and I like it. It's interesting. It's amazing how quickly things change, especially when you're talking about tax laws. That's one of the reasons I'm really glad I have so many contacts in that field, because whenever I have a question, I can get it answered pretty quickly. Because to keep up with the 10,000 some odd mutual funds, are actually more than 10,000. But if you cut, just say more than 10,000. There are several thousand exchange-traded funds. It's a lot to keep up with. And then they have these things, they're mutual funds, but they're inside of variable annuities, so the gains are all tax-deferred. And those are counted as a different class of fund. So you add them all up together, it's about 100,000 funds. What's amazing, and by the way, there's a lot of overlap in there. A lot of the funds will have 5 versions of one fund. So if you wanted to assume that they all had 5 versions of one fund, which they do not, there's still around 20,000 funds. Enough to make your head spin. And, it's pretty fascinating. When you've had a time period that is been as unproductive as the past couple of years have been, I mean, the gains are not real significant across any of the categories. So I had an idea about a research project, and I just started it, and I started looking at, and I am looking at all the major indexes: large cap, mid cap, small cap, both the Russell and the S&P 500. We're looking at international emerging market. Those are all the equity, large categories. And it's pretty amazing. You go back, the longer period you go back, let me put it that way. The longer period you go back, the closer their returns come to one another. In the short run, anything less than 10 years, your guess is as good as anybody's as to which category is actually going to win. And with the advent of computers, actually with the popularity of computers running portfolios, it's really, the price movement it doesn't trend like it used to. The trends are a lot quicker, they're shorter, and then they go back down again. And so it's a very challenging thing. Things have changed. And what can you do about that? Well, you can actually, it's a lot. You can diversify. You can do a great job of diversification. Actually, an individual investor today, one of our clients, we've got them diversified the way that only big institutions were able to 15 years ago. And I think about the last 15 years, I know a lot of probably 45-year-olds are going, wow, that was forever ago. Wait till I get my age. But just 15 years, I may remember it like it was yesterday. And it's just, the change has been incredible. And it's been constant. And it's constantly evolving. And there's some really good ideas out there. In fact, maybe next week, when I remember to bring my laptop in, I'll have I'll have more information on some specific funds for you. But I really like it. I like what we do here today. I've so many services. They are very expensive. It would be tough to do this on your own. Well, the information that you get is not. It's basically about maybe 15% of the information that you need to make a really well-informed decision. That doesn't stop a lot of people. I understand. You look at the 1, 3, 5 year track record, and that's how you pick your funds. And I it's like driving to work, looking in your rearview mirror. That's how you're gonna get there. You're gonna look at a rearview mirror to see where you've been. and it's the same. And you can get away with it for a longer period than you could trying to go to work that way. Do not try to go to work that way. That is not advice. Absolutely not recommending that you try to go to work and drive your car by looking in the rearview mirror. Okay. Now, you can do that in the stock market, and you're not going to crash into anybody. But at some point in time, your portfolio is going to hit a wall. At some point in time, you're going to be in something, and it's going to drop a lot, like a lot. And the average funds are incredibly volatile. So you're talking about, big drops. And I've lived through several of those during my career where things went, they did very well until they didn't. And at some point in time, valuation does matter. That means how much are you paying for that stock versus how much it should normally sell for. Like if somebody said, look, I got a CD that's paying 5% right now. Great. And by the way, those were available just a few weeks ago. I didn't look this week because I didn't do much in CDs this week. But anyway, if one's paying 5% and another one's only paying 3%, which one do you want? Not a trick question. And it's really funny. I don't even ask that question when you sit down and we're trying to figure out what kind of a plan that we're going to put together for you and then run that plan. That's another thing that's awesome. Do you know how hard that was to do 10 years ago? To do customized plans for people? I'm going to tell you, it was nearly impossible. And but today, not a big deal. There's all kinds of software out there. It helps us. It gets out of balance, lets us know, hey, this is out of balance. And we can go in and make a couple transactions. And what I kind of find funny is that, the older models where you're using individual stocks, those had a lot of movement in them. Well, when you're using an exchange-traded fund, the movement's going on inside the fund, and you don't have to see it. You also get to avoid paying taxes on it until you actually sell the fund. That is a huge deal. That is phenomenal. I can't tell you how much that increases returns on a lot of ETFs. Now, you have to check because not all of them, but I'm going to tell you about 85% of them. 85% of exchange-traded funds do not distribute capital gains throughout the year. They may distribute dividends, but that's okay. That you'd have to pay tax on that anyway as well. But what was really aggravating about a normal mutual fund is you'd have a bad year, and it might have come after 3 or 4 good years, and all the gains in there that you may not have gotten if you had invested that particular year. Let's say your luck was bad, and you got in, the fund was down 15, 20% for the year, and then you get this big fat tax bill for all the capital gains that were distributed for all the people that panicked and pulled out who had gains in them that were in there for years ago before you. That's a bummer. Lose money and then get stuck with paying taxes on someone else's gains. Woohoo! Sound like fun? But you can avoid that with exchange-traded funds. And that, we look at that when we're trying to put a portfolio together for you. Well, I'm looking at which funds are more tax efficient And it's really funny. I mean, I just automatically started doing that when I read about it, years ago. And now people are advertising, oh, yeah, we do that. And I'm like, really? It only took you 10 years to figure that out? But and a lot of them were, right off the bat doing the same things. So it's crazy how different things are, though. In the long run, by the way, if you want to make this really simple, there's some super simple funds I own and the reason I own them is I like the simplicity of the formulas that they use to select the stocks. And they're really simple. I mean, my favorites are size, speed, and profitability. They have different names for those three factors, but as long as they're included, those are my favorite funds. They look at size, small, medium, large cap typically. They look at speed. That's how fast it's going up. They refer to it as capitalization. And then profitability. And they all have slightly different ways of measuring. Then they're all pretty good. Tomato, actually. And so you get those three factors going on inside of a fund. You give that fund a long enough time period, it's probably going to do incredibly well. But you got to give it a long time period. If you're close to retirement age and you're thinking about taking income, but you're going to have some growth in the portfolio as well as income, okay, you would use these, but in smaller percentages. And that's if you get this wrong, this is one of those things. And I have to apologize. Every time I hear somebody say, you've got to get this all right, or these are the 8 new things you need to know. And 19 out of 20 times, it's not that important. It's just marketing, which makes it incredibly difficult because every time you hear something, when somebody comes out with something that's relatively new, the amount of time that it takes to research that to either confirm or debunk what they were saying, you've got several hours. And you know why they do that? Because they know you're not going to check it out. When you try to verify, you're going to spend so much. By the way, several hours is from a person like myself who does it every day and has been doing it for an incredibly long time period. I'm probably a little quicker than the average person that's trying to figure that stuff out. And so it's marketing. Lovely. That's the thing you really have to prepare for is all the marketing that you're going to get. It's like I'm going to talk a little bit about fixed indexed annuities a little bit later in today's show. And man, the marketing materials on that, I'm looking at that. It takes me an incredibly long time to work through one of those new products that they come out with, like every 6 weeks. And why can't they stick just to like bonds? I'm just kidding. And bonds are good, but bonds have always been kind of complicated. Most people think of CDs, and CDs are very similar to bonds. You put your money in a CD, and it's going to be whatever it is, 6 months, 1 year, 2 year, 3 or 5 year, whatever. Typically, the longer you're willing to hold the CD, the higher the interest rate, but not this past like 18 months. The shorter term, we're actually paying more than the longer term. They call that an inverted yield curve. That's what they're talking about. Normally, the shorter the time that you're holding on to it, the lower the interest is because, it's a shorter time period. And but when the shorter ones are paying more than the longer ones, they call that inverted or upside down. The short ones are paying more instead of paying less. That's just what that means. And when you hear the pundits saying inverted yield curve means a recession is coming, no. An inverted yield curve means they're trying to create a recession because inflation is going up too fast. And so it's not that they, anyway, they're trying to give it attributes that it really just doesn't have. There's this thing in statistics, correlation or causation. Correlation means when this happens, this has happened this percentage of the time. Okay, but that could just be luck. If it's causation, I like to use a We used to call them teeter-totters when I was a kid. Kids get on each side of a big pole that was bolted to a bigger pole and had a little seat and a handle on it, and you'd be going up and down. Well, if bonds worked the way they were supposed to, that's what would happen. When interest rates would rise on one side, the other side would go down. And when the other side rose, they would go down there. When they are going both at the same time. Hey, you know what? I actually have a phone call here, and I'd forgotten to even give the telephone number out. The phone number is 216-901-0945 if you want to call in here, 216-901-0945. And I will also say, if you hear something and you'd like more information on it, please feel free to give me a call or go to my website, and it's bullingtoncapital.com, and it's spelled Bullington, capital spelled capital.com, and I will definitely try to help you out there. So it looks like I got a caller from Jason.
Yeah, how you doing today?
Good. How are you?
Pretty good. Hey, I had a quick question for you. Who do you like now that manages mutual funds or actively manage ETFs that you think can beat the S&P 500? I know for years, Peter Lynch and had the Magellan, and Dandoff could beat it with Contra for a while. But the research that I've done, it seems like it's few and far between that you can find ETFs or mutual funds that are actually going to beat the S&P 500, on average over a period of time. Who do you like now that is still able to do that? Their funds haven't gotten too big, or they have the research where they're able to correctly pick the stocks, in the funds or ETFs.
Well, here's the thing: the regular mutual funds are not real popular anymore. They're
I don't like them that much because you're fine in a IRA where you don't have to worry about the capital gains, but the expense ratio is high, and I'm not dealing with the capital gains in a taxable account.
Right. Yep.
But I do have some that if they're worth it, and like I said, in non-taxable, if they can beat the indexes, I'll hold out. I'll keep them. You know what I mean? But
right.
I haven't found that many.
Yep. Hey, Jason, you know what? Can you hang on? I got to take a real quick commercial break.
Yeah, I'll be here.
Okay. All right. Thanks. This is Bill Bullington right here on 1420. I'll be back after these commercial messages. All right, thanks. Jason, you still there?
Yeah, I'm here, Bill.
Okay. Hey, I was going to tell you that, I look at mutual funds all the time. I've got the Morningstar database, and it's got everything in it. Anything you can think of is in there. And, yeah, I'm with you. What's really difficult about a traditional mutual fund is when the fund is small, it'll normally put in its best track record because it's easier to turn the portfolio over. That's one of the reasons. And when they get larger, it just gets harder and harder to try to beat the indexes. And you're right, very, very few of them will. And unfortunately, you got to have a crystal ball that works to figure out which one that's, which one's going to do it. Everybody that's running a fund has an incredibly large amount of education and experience because they don't put rookies out there, and see what they're going to do. That those days are gone. So, and they all have a really tough time outperforming their benchmarks, whether it's the S&P 500 or emerging markets. They all have a tough time, and I think most of it's because there's so many ETFs out there, and there's so much money in it that it's making stocks behave differently than they have in the past. And this has been going on now for 10 years. But
yeah. Do you like any active ETF managers that you think are? Because some of them, they have algorithms that they'll use to screen and stuff, and a lot of them work pretty well. They give you diversity. They might not beat the S&P by much, or it might be similar, but at least you have some diversity in it. still. Do you have any that you like there? I mean, I know there's huge companies, BlackRock, Invesco, but is there any particular actively managed ETF guys out there that you like?
There really aren't. And just because it's very difficult to maintain that. When they get to a certain size, I'm going to tell you the chances of them doing that are almost as good as me running a sub 4-minute mile. And
okay.
There's a chance. It's not a good one. The market is so clearly defined, I think, today by size. Everybody knows every single stock that's available, that's eligible to be in a fund. Mutual funds not allowed to invest in just anything it wants to. And they have restrictions over the size of the companies that they can actually invest in. And they have restrictions over how much of the company they can own before they have to start filling out all the forms, letting everybody know, hey, we're going to go above this amount, and then that oftentimes pushes the price of that stock higher. People trying to jump in before they know these guys are going to have to buy. It's kind of a mess, really.
Okay.
But I would literally stick to the ETFs, the ones you like the most. I like the growth, and here's why. The growth ETFs have an algorithm that I was kind of referring to earlier. They're looking at the growth in sales, and a lot of them will add things like they've increased their income each year, their sales each year, and they've also increased their dividend each year for 4 or 5 years. There's a bunch of different ways of looking at this. And I like those because those are numbers that you can actually calculate, and they're just math. There's no emotion in it. There's no evaluating. And so they go
for the non revenue growth sales, like something like a moat. How difficult it is to compete against them or an industry
that's a subjective. The moat is a subjective variable.
Yeah, that's what I was going to ask you. What's the best way to look to figure out that?
Well, that's what all the professionals out there are trying to do. I look at here. I've owned Procter and Gamble for a long time. I use probably a quarter of the products that they make. They make a ton of products, by the way. But and if you went to their website and looked it up, you'll see a ton of things that you might use, like Tide's in there. I think Gillette used to be owned by them. They might have spun it off by now, but there's just a whole ton of products there. There's Pampers. I mean, Mr. Clean, all this stuff. You see it all throughout all the grocery stores. The profit margins on it are really good. The dividend yield on it is okay. It was really good when it dropped here a couple of years ago. Well, during the pandemic, everything got crushed. So I literally bought twice as much as I made on my first purchase. So that worked out really well. But you can't guarantee you can do anything like that, by the way. And I wouldn't want to see the market come down another 40 or 50% just to give me that opportunity.
No, I know what you're saying. You were getting them when the dividend was like 2.5%, as opposed to whatever they're at now, 1 something probably.
I think the dividend yield on it got up to about 6 because it had dropped so much.
Oh wow!
Yeah, that's like I was going. What? You think people are going to quit washing their clothes? I mean, because they make Tide and taking baths.
Right.
So occasionally you can find those, and man, anytime you see like a big name brand that's been around for a long time, when the market's down like a lot, more than say 25% or so, that happens more frequently than it used to. But that's when you want to go and check those names out, like Hershey's and just household names, big companies. The dividend yield is probably going to be slightly higher than it was before it dropped. Well, it will be before it dropped. And when the valuations get down, you're pretty good to go there.
That's good. Yeah, that's good. I appreciate you mentioning that. I didn't think of it that way. I know. Obviously, when it's down, the dividend yield will go up on a lot of companies. But ones like they have the shelf space. People aren't going to be switching. There's not a lot of choices out there for detergent, and many of the brands are owned by that one conglomerate.
Yeah. Yep. Yeah. And so that's, that would be the kind of thing that I would look for if you wanted to supplement or complement the ETF solutions. And ETFs, by the way, I like the fact that they're transparent. You can get online and look up all the holdings in a fund. And you can,
yeah. You don't have to wait for the end of the quarter to find out what they bought the previous quarter.
Right. Yeah. Yep. And so that really helps out a lot too. But as far as the mutual funds, I mean, there are some pretty good. Harbor does a really good job. The Invesco's got some fairly good actively managed. BlackRock and Fidelity both brought out just a couple of years ago some actively managed stuff. Kind of surprised everybody, and those are tough. I mean, normally when you saw an actively managed fund that had a long-term track record that was better than the S&P 500, it normally comes over fairly short time periods where that fund will just, whatever they made big concentrated bets on paid off, and then the fund will go back to sleep again.
Yeah.
As they're looking for the next big winners. And so it can be really, really frustrating. And, you get managers out there that definitely know what they're doing. I think Peter Lynch would have a tough time today. They all have a tough time. And one of the biggest reasons with that, because of that, is kind of what I was talking about earlier, is that, all these stocks that are available for investment by a fund, they're all known by all the portfolio managers. And it's tough to have a leg up. So I think when you look at the expense ratios of the ETFs, they're like, what, 10 basis points is an expensive one? That's 10 100ths%.
Yeah.
And that's.
Do you have any worry that the market cap S&P 500 ETFs that are too concentrated in like the top 5 tech companies? I mean,
yeah, that bothers me. I'm not a big fan, so I don't hold just that. And Russell 1000 is nearly identical to the S&P, except that it's 1,000 companies instead of 500. And so that's my kind of favorite choice over there. And then I like a lot of the other Russell ETFs too. Mostly BlackRock's done most of them. There are a couple of other vendors that get into that space, but what I really like is being able to, like, I put this semiconductor model together quite a few years ago, and that thing just knock on wood, just go check out how semiconductors have done any of their funds. And when I was purchasing them, the price to sales ratio, and here's when you're looking for funds, I have tools that help me do this, but you want to find out what the price to sales ratio, the average price to sales ratio is of that fund. Price to earnings ratio are not very helpful anymore because there are so many rules involved and people are able to report their earnings so many different ways. And sometimes it's, most of the time, I mean, if you had a choice of reporting $1 a share or, 75 cents a share, which would you report?
Yeah.
So, there are a lot of things that you can do, but it's really, really difficult to manipulate your sales. If you start manipulating your sales, you're going to run into trouble with the regulators. Okay. So, and with sales, and you just have to become a little bit familiar with the company's past. Like I can tell you, Procter & Gamble's average net after-tax profit margins are around 12% over the past 10 years. And that's pretty good. 12% net after all fees, expenses, and taxes. Okay, so not too bad. And that's one of the things I liked about that company. You look at Ford or GM, and those guys will lose billions of dollars when cars aren't selling. And then when they are selling, they'll make billions of dollars. So they're too erratic. They're all over the place. And you'll see Hershey's, Clorox, companies like that, they're going to have more, they're never going to be smooth. But when they have a bad year, the profit drop by like 4 or 5%. And if they have a super bad year, it might go down 15 or 20%. But not like a lot of the smaller companies that you see where they'll go from making money to losing money, or they've never made money and they just keep losing money.
Yeah.
Those are hard to place a value on. And that's one of the reasons, like, I like to use the ETFs as well. But with ETFs, you can get sectors. So if you have an idea that sectors, like healthcare has slunk up the joint in the past 3 or 4 years. But if you look out over the long run, it's done a lot better. And if you're going to be in stocks, you better expect that kind of thing to happen. But
yeah, the XLV, I think, and VHT, if you want the little bit smaller ones, are good for that healthcare. I like.
Yeah, yep. And I think the healthcare is a great place to invest. Why? Because I just joined the fastest growing segment of the population this year, 60 and over. And that's the fastest growing segment of the population in the United States. And worldwide, populations are aging. And I can tell you, I've been to the doctor more frequently in the last 5 years than I had been in the previous 25.
Yeah.
And it is not cheap. So.
Oh, yeah.
So I think they have.
Thank you.
Go ahead.
Oh, go ahead.
Oh, you're good. Go ahead.
I was just going to say I didn't want to monopolize all your time. So I appreciate all your words of wisdom.
Oh, well, thanks. I appreciate you calling in and listening. So
thanks, Bill.
All right. Have a good weekend.
All right. You too.
Bye-bye. If you'd like to call 216-901-0945, 216-901-0945. I can remember when I just got started in this industry. It was in the was just right after the crash. I mean, just right after the crash in '87. Remember that one big drop? It's like 20% in a day, and everybody's like, "Oh, it's 20% in a day," and I was looking at it, I'm going, "Oh yeah," except that it was already down 15% before that one day drop. That was just the icing on the cake. But I forget who it was. P&O Lynch was still managing the Magellan Fund, and his funds, they were more volatile than the S&P 500, but they also had better track record. And his fund wasn't really he talked about that in his book, one of his first books. And it's so funny today that kids today don't read stuff from people in my age bracket, because they think they know better, and they think they know better by assimilation. I think maybe that's where Trump got that idea. Yeah, I was just near it. But anyway, and it's very practical. So if you want to read good books on investing, you want to learn a lot, he doesn't go a lot through, he doesn't talk about how to calculate, what the return on assets or return on equity, price to book, price to sales. It does hit the PE ratios just a little bit, but he didn't do a lot of it's not technical. It gives you a good idea, though, of how stocks actually move. And once you figure that out, now one of two things is going to happen. You're either going to be looking for, hey, Bill, did you say those fixed indexed annuities were paying more than 6% on an income? Yes, I did. Depends on your age. And actually, it goes up each year that you don't take it. So if you're in your 60s, the income right now is pretty easy to get about a 6% yield. And by the way, they will invest the money in an index. But I don't think the index is going to keep up with the guaranteed portion. Yeah, that income that you could get if you decided to take it right away, will go up. And they've actually raised that. Now I don't even remember what the rate is. It's going to go up more than the average investor makes in the stock market. Okay, each year, the amount of income that you could get that they will guarantee will increase by a level more than what the stock market has done. Now, once you turn the income on and start taking the income, it freezes. So it's not going to keep going up when you take it. But I got to take a quick phone call here. Oh, actually, I'm going to ask TJ North Olmsted to hang on, because about 60 seconds we got to take a commercial break. And after that, we'll be right back here, and I'll finish up on where I think where the fixed index annuities might fit in your portfolio. I own it, by the way. Incidentally, I own everything I talk about. I own stocks. I own ETFs. I own mutual funds, treasuries, CDs, annuities, the whole 9 yards. And actually, I think it's only about 6 or 7 categories, but there are a lot of stocks in my stock portfolio, but there are only 6 or 7 big categories that I actually invest in. But yeah, if you want to, if you'd like to talk in person, you can go to my website. It's bullingtoncapital.com, or you can call us. Just leave a message, 330-664-0700, 330-664-0700, and hear the music. That makes me want to take a break. I'll be back right after these messages.
I keep fighting voices in my mind that say I'm not enough.
Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to ask me a question, talk about your personal situation. We didn't get much into the personal planning, and I wanted to cover that more in more detail. So on future shows, we will do that, and basically retirement planning. And I like to say you're never too young to start planning for retirement. I wish I would have started at about the age of 12. Purportedly, that's when Warren Buffett started. And anyway, but I got to take a quick phone call now. And the phone number here, if you'd like to call, 216-901-0945, 216-901-0945. And I'm going to TJ in North Olmsted.
Thank you for calling my call, taking my call. This is a little bit offbeat. What you're discussing is in a normal time, but we're heading into a very abnormal time politically, which has an effect. For instance, what is Yellen going to do when she declares that you can't be using paper money anymore because there's too much counterfeit money out there, and you're going to have to go to digitalize, in other words, using credit cards and what have you. Mm-hmm. And all this is starting to trigger something bigger that's going to be taking place right now. We're on the verge of a potential war. What happened on the 8th of this month with them going after the former president is going to trigger a lot of things financially and politically. For one, China's going to get a lot of testicles and want to go after Taiwan. Right now, the threat of going after Israel with nuclear weapons from Iraq and Iran is on the table. Now, when you have a peaceful time, you can talk about this money and what you want to do with your investments. But we're on the verge of some very, very serious political and global disasters that are about to happen.
Yep. Well, here's the thing. If that happens, everybody's going to be in the same boat. There will be rapid inflation, despite the fact that everything is going down, and the inflation is going to come just like it did in Germany in the early 1900s because England, kept demanding these reparations, and it started another world war.
Correct.
But I just don't think we're just not that close to there yet. And when people look at China, and China's extremely strong as far as economic influence worldwide. Okay, but the United States is their biggest customer. So,
would you disagree with the fact that if there is a global war that breaks out, the disaster it's going to cause economically and with the money system is going to be major?
Oh, you're going to see wild fluctuations, and you'll be glad that you've held on to some short-term bonds. and I actually have a short-term bond fund and some short-term bonds. And I know what's in the fund, and I know who's managing it, and I know what they're going to do. And believe me, it's run by Fidelity, and Fidelity is the largest fixed income manager on the planet. They're bigger than BlackRock. They're bigger than Vanguard. And I'm telling you, those guys, they know what's up. They're really. I've been to meetings with these guys, like people that run the entire investment research for the entire company, And
well, if I may, I was born in 1930, 1 year after the Great Depression.
Mm-hmm.
I had the opportunity to be 11 years old. During those 11 years that I was growing up, I saw the change of what occurred in America. Then World War II came along.
Pulled us out of
And
recession.
we had to mobilize, and manufacturing jumped, and people were making all kinds of money.
Absolutely. To think about what you just said, that was a war that ended the Depression.
Correct.
Yes, I know.
Exactly correct.
And by the way, the Fed had literally almost no power in the beginning of the recession. They were formed.
Well, they were formed in 1913, correct?
Yes. Yep. But they weren't given it. They didn't have any power. They didn't have any influence over an awful lot of stuff. And when those banks started going belly up, they put out the FIDC and FIPC.
Hold it right there. When the banks started going belly up, and that's my point.
Well, see,
What
now today,
triggered the belly up?
here's what you would get. If the banks were just like this place out in California had all those billionaires' money, they stepped up and made good on that. Now, that's inflationary. Okay, that should be completely inflationary. And I think what the government would do, instead of saying, doing what they did in the early 1930s, that's why it drug on so long, because I'm getting older. My memory's not as good as I forgot who it was.
Well, you're still a young man. I'm 92, so.
Oh, wow. That's funny. But anyway, they tightened instead of loosening the money supply. I mean, it was crazy. And they just didn't have any experience. And now we've got 100 years of experience, and this has happened multiple times. So the net effect, in what I think would be the net effect, and I might be wrong, and wouldn't be the first time, is going to be a much higher inflation rate than anybody ever wants to see. And that's going to make it that whether prices drop by half or prices double, you're in the same boat.
Question for you. What brings on the inflation?
There are a ton of items that contributes to that. And it's like, are you familiar with the game Whack-A-Mole?
Vaguely, but please clear me up on that.
Okay, so the kids play this, used to play this. I don't know if they still play it or not, but they used to take them to these indoor gaming areas, because in Northeast Ohio, it gets cold in the wintertime. You got little kids, they get kind of antsy. So they give them this great big mallet it was soft, couldn't hurt anything with it, but these moles would pop up out of these holes.
I recall now, yes.
Well, those moles, those are all the potential variables that can pop up and cause inflation. and
I have another question, if I may, for you, because I think I know you're very astute.
Oh, thanks.
If there were a depression that hit similar to the one in 29, God forbid, or the Creator forbid,
yep,
all these people that are living in these very, very high-priced homes in these neighborhoods, they're not going to be able to maintain it with the taxes and the mortgage payments. Who is going to get those homes back? The banks?
The banks, worst case scenario.
Worst case scenario is what I'm shooting for.
Yeah. Well, I don't think I'm going to live long enough to see the worst case scenario.
God willing, you won't.
Yeah, absolutely. that would be rough. But the banks would end up owning, just like they did in the 2006, 2007, 2008. They would end up owning a lot of the properties. The Fed would have to step. The Fed would have to step up.
They also ended up, after the Great Depression, owning all the properties.
Yeah.
And reselling them for a heck of a lot less than the people that had those homes lost everything they had. I will listen to the rest of you on the air, and thank you so much
Okay.
for giving me the time.
Well, thanks for calling in. Have a good day. Yep, it's that's interesting to find somebody who's lived through the Great Depression. All my grandparents and great grandparents my great grandparents were just coming of age during that time period, so that was. It was really rough. you're always going to have, and that here's what's genius about this country, and it's really what gives me faith, literally, that there's a God. Okay, I'm just going to throw that out there, because men by themselves are not smart enough to have developed a system without divine intervention. Those ideas were planted in somebody's head somewhere. Yeah, I mean, I'm kind of joking here, but the Fed, it was a stroke of genius. Fractional reserve banking system, and at first you had to have reserves, in gold and silver and all that stuff, and then they figured out that probably wasn't going to work that well. It took them until 1970s, to figure that out. And now I'm telling you, you can print your way out of any problems. Now, people that have any background in economics are rolling their eyes right now and going, "Oh, you don't want that to happen." And I know we don't. But it's the better alternative. And what do I mean by printing it out? Just like the government printed money and gave it to people during the pandemic who weren't working, that was a gift. Okay, they just printed it and handed it out. And if things got super, super bad, that's what the Federal Reserve's job is to evaluate how well or poorly the economy is doing and to adjust the supply of money. Most people think all they do is set interest rates, and I've just been told I only got 60 seconds left. So I'll pick back up on this. In the meantime, if you like the fixed index annuity ideas, the rates are 6% and up depending on your age. So you have to call in to see what that might be. They're a really good deal right now, and that those are guaranteed until you die. So even if you withdrew more than you had in the account, they're still going to pay. So I think those make a lot of sense in today's environment. And I still think if you're a long-term investor, you got at least 10 years. Stocks are probably a really good place to be. I didn't get to talk about the factors that have had a tendency to have made a big difference in the returns on these. And I'll come back to that next week, and we'll finish up that conversation on which categories have done the best over the past 10 years and why I think that they've done the best. Anyway, I hear the music. That means the show is definitely over. This is Bill Bullington right here on 1420. Stay tuned for future entertainment, and I'll see you again next week.
Just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.